It's Tuesday, May 13th, 2025. Breaking news tonight. While most states are stuck in neutral, Arizona just slammed the brakes on crypto hard. Governor Katie Hobbs went on a veto spree, axing not one, not two, but three bills that would have pushed the state deeper into Bitcoin territory. First, she killed the Digital Assets Strategic Reserve Fund, claiming crypto's volatility is no place for public funds. Fair, but tell that to the Fed's balance sheet. Then she shut down a proposal to let the state invest up to 10% of its treasury and retirement money in Bitcoin. And just for good measure, she also vetoed a bill that would have let folks pay taxes and fines in crypto. Apparently, Arizona can handle 120-degree heat, but not blockchain transactions. But just when you think Hobbs was about to build a firewall around the state, she flipped the switch and signed House Bill 2387, regulating Bitcoin ATMs. Under the new law, kiosks must post multilingual scam warnings, issue detailed receipts, and limit newbies to $2,000 per day. If you get scammed and report it with proof within 30 days, full refund, including fees. That's right, Arizona won't take your Bitcoin, but it will get grandma's Dogecoin back if she sends it to a prince in Lagos. The crypto contradictions continue. I'm Max Voltz, and this is CryptoWars, where blockchain's too risky for pensions, but totally fine if it fits in a kiosk next to a Coinstar. And speaking of contradictions, the SEC is back at it, wielding red tape like a samurai sword. On Tuesday, the agency delayed its decision on whether to allow in-kind redemptions for BlackRock's iShares Bitcoin Trust ETF. Right now, the SEC prefers a cash-only model, which forces BlackRock to sell Bitcoin and return dollars to investors, rather than giving them Bitcoin directly. Why? Because letting people actually own the asset defeats the purpose of tightly managing exposure, apparently. Nasdaq filed to allow in-kind transactions back in January, which could make ETFs more efficient, transparent, and frankly, more crypto. But the SEC kicked the can again, opening up a public comment period instead. Legal issues, policy implications, yada yada. Meanwhile, the commission also delayed decisions on the Grayscale Solana Trust, the Grayscale Litecoin Trust, and the 21 shares Dogecoin ETF. That's right, even Doge is stuck in regulatory limbo. But here's the twist. Since Trump returned to office, the SEC has dropped lawsuits, opened roundtables, and installed Paul Atkins, a new SEC chair who isn't shy about dragging the previous regime for their regulation by enforcement tactics. Change is in the air, but the pace? Still slower than a Solana validator on Sunday. Meanwhile, Missouri is putting its cowboy hat on and yee-hawing toward crypto freedom. House Bill 594 just passed the state legislature. It is now sitting on Governor Mike Kehoe's desk, ready for a signature. If it becomes law, Missouri residents could spend or sell their Bitcoin without paying a single dime in state capital gains tax. Unlike Rhode Island's limited version, Missouri's bill rewrites the entire adjusted gross income structure, potentially nuking taxes on Bitcoin altogether. Sure, it could cost the state $300 million a year, but who needs school funding when you've got Satoshis? Republicans say it'll stimulate growth. Critics say it's reckless. But if signed, Missouri would become the first state to say, taxes? Nah, to crypto gains. The show-me state might just become the no-tax zone. Now to Wall Street, where Coinbase just pulled off a market miracle. The company is officially joining the S&P 500, replacing Discover Financial, and investors responded like it was Bitcoin halving day. Coinbase shares exploded, up 24% in a single session, the biggest one-day jump since Trump's election win in 2016. Why the pump? Index funds tracking the S&P 500 are now forced to buy Coinbase stock, meaning billions in fresh capital flowing straight into crypto's biggest U.S. exchange. Brian Armstrong, the Chrome Dome of crypto, helped grease the rails with $75 million in campaign contributions through a pro-crypto PAC. Because nothing says decentralization like super PACs, right? Let's be clear. This is a seismic moment. Coinbase isn't just the crypto on-ramp anymore. It's now mainstream enough for the same index that includes Apple, Exxon, And while the Trump administration flirts with crypto through executive orders, Coinbase is busy doing real deals, like its $2.9 billion acquisition of Deribit in Dubai. They're not playing catch-up, they're playing kingmaker. And finally, Jack Mallers just pulled off a baller move that only a true max-level Bitcoiner could. His new company, 21 Capital, partnered with Tether and dropped a whopping $458.7 million to buy 4,812 Bitcoin. That's not an ETF. That's not a fund. That's an outright treasury acquisition with laser eyes and no chill. The coins are being held transparently in a public wallet by Tether, and the firm is going public under the ticker XXI, a wink to Bitcoin's 21 million hard cap. At launch, they'll be holding over 42,000 Bitcoin, instantly ranking just behind MicroStrategy as one of the largest corporate holders on Earth. Mallers says he wants to make sure every shareholder gets wealthier in Bitcoin terms, not fiat. That's not just strategy. That's ideology. I'm Max Voltz, and this is CryptoWars. This broadcast is powered by you, our listener-supported crew of digital rebels. No corporate overlords, no shady sponsors, just truth, memes, and monetary mayhem, live every day from deep inside FEMA Region 9. So detonate the subscribe button and help us keep the signal alive. Because in the age of engineered chaos, CryptoWars is your daily dose of decentralized clarity.